Have you ever looked at your bank account and felt like you were standing in financial quicksand? You worked hard for 40 years, you saved every penny, and now you finally want that money to take care of you. But every time you withdraw a little for groceries or a well-deserved trip, the balance seems to drop faster than you expected. It is a terrifying feeling to watch your life savings slowly vanish while the cost of living keeps climbing higher and higher. You might hear about investment funds paying 20 or 30% interest every year, and your first thought is probably, what is the catch? Because let us be honest, in the financial world, high yield almost always means high risk or a slow decay of your hard-earned capital. Most people are bleeding cash through common traps that have become invisible to them. They see a double-digit payout and think they have found a gold mine, only to realize a year later that their principal has been cut in half. Suddenly, that 30% yield does not feel like income anymore. It feels like your future is being sold off piece by piece. My name is Nick, and today I am going to show you that it does not have to be this way. I have analyzed the market to find 5 specific funds that change the narrative entirely. These are 5 exchange-traded funds that pay massive monthly income without draining your portfolio. We are talking about yields between 15 and 33% that actually have the potential to grow over the next 10 years instead of decaying. By the end of this video, I will show you a strategy that could turn a $10,000 investment into a $150,000 portfolio. Imagine receiving nearly $30,000 a year, or about $2,500 every single month in pure dividend income. Before we jump into the list, we need to talk about why so many high-yield funds fail and how you can spot the difference. The biggest mistake most retirees make is chasing the highest number without looking at the chart. If a fund pays you 20% but its price drops by 25% every year, you are not investing, you are just withdrawing your own money and paying taxes on it. That is what we call principal decay, and it is the fastest way to run out of money when you need it most. The funds I am showing you today are built differently because they use protective strategies like buffers and tail risk insurance. They do not just hope the market goes up, they turn market volatility into steady cash flow while keeping your initial investment intact. Let us start with number 5 on our list, the Global S&P 500 Tail Risk ETF, ticker symbol XTR. I like to think of XTR as the workhorse of a retirement portfolio because it is built for consistency rather than flashy short-term gains. It is designed to pay you through market turbulence by earning income from chaos while keeping your principal safe. XTR holds the same blue-chip stocks that make up the S&P 500, including giants like Nvidia, Apple, and Microsoft. But the real magic is in the overlay strategy. The fund sells covered call options to generate immediate income and uses part of that money to buy protective put options. This creates what we call an income seatbelt. When the market is calm, you collect your dividends, and when the market crashes, the insurance kicks in to cushion the blow. Right now, XTR delivers an 18.38% dividend yield paired with modest annual price appreciation. For someone who values sleep over excitement, this is a powerful way to stay invested in the best companies in the world without the constant fear of a market crash. Moving to number 4, we have the FT Vest Gold Strategy Quarterly Buffer ETF, ticker symbol BGLD. Gold has always been the ultimate safety net for investors, especially when inflation bites, but the problem is that gold does not pay dividends. BGLD changes the game by turning the stability of gold into a steady monthly cash flow machine. It does not hold physical gold bars in a vault. Instead, it uses a mix of United States Treasury bills and option strategies linked to the price of gold. The standout feature here is the quarterly buffer, which acts like an airbag for your investment by absorbing moderate market drops. It harvests premiums from option activity, essentially transforming the price movements of gold into a reliable 19% yield. If you want the safety of gold but you also need a monthly check to pay the bills, this is a remarkably disciplined choice. Now, let us look at number 3, the Yield Max Semiconductor Portfolio Option Income ETF, ticker symbol CHPY. This fund takes the wild energy of the semiconductor industry, which powers every artificial intelligence and smartphone on Earth, and turns it into income. The semiconductor sector is famous for big price swings, which usually scares away conservative investors. However, CHPY profits from that volatility. By selling covered calls on companies like Broadcom, Nvidia, and Taiwan Semiconductor, the fund collects larger premiums whenever the market gets jumpy. It offers a staggering 20% dividend yield. While the growth potential of the stocks is capped to provide that high income, it remains a powerful volatility capture strategy. It is for the investor who understands that technology is the future, but wants to be paid today instead of waiting 10 years for a stock price to rise. At number 2, we have a favorite among income seekers, the Global X NASDAQ 100 Covered Call and Growth ETF, ticker symbol QLG. This fund is the perfect middle ground because it is split exactly in half. Half of the portfolio is built for pure growth by tracking the NASDAQ 100 giants like Amazon and Tesla. The other half is dedicated to generating income through covered calls. This 50-50 mix is the secret to why it is so popular. You get the steady income of high-yield funds combined with the long-term upside of the digital economy. Currently, QLG offers a 23.79% dividend yield. It accepts a bit more volatility than our first two options, but the trade-off is a much higher potential for your total account balance to grow over time. It is the definition of having your cake and eating it too. Finally, we reach number 1. The NEO's Bitcoin High Income ETF, ticker symbol BTCI. Many people over 50 are skeptical of cryptocurrency, and for a good reason because the price swings can be stomach-churning. But BTCI is not about gambling on the next big crypto trend. It is about turning the massive volatility of Bitcoin into a monthly cash flow that looks more like a high-end pension. The fund holds over 60% of its assets in safe United States Treasury bills while using options on Bitcoin to generate yield. Because Bitcoin moves so much, the premiums the fund collects are enormous, resulting in a dividend yield of 32.47%. It trades away the wild, explosive growth of Bitcoin in exchange for predictability and protection. When Bitcoin surges, your income stays high, and when Bitcoin drops, those same premiums help cushion your account from the full force of the fall. Now let us put all of this into perspective with some real numbers. Imagine a man named Josh, who is 55 years old and has $10,000 he wants to put to work. If Josh invests that $10,000 into a strategy like BTCI and reinvests his dividends, the results are life-changing. By the end of the first NUM, his portfolio is projected to be worth around $14,000, generating $3,000 in annual income. By year 5, that same $10,000 starting point could grow to $43,000, paying $9,000 a year in dividends. And if he stays the course for 10 years, his portfolio could reach an incredible $153,000. At that point, he would be receiving close to $30,000 every single NUM in dividends alone. That is $2,500 a month, which is often more than many people receive from Social Security. And the best part is, he still owns the $153,000 principal. This is how you escape the financial quicksand. You stop being a victim of the market, and you start becoming a strategic collector of income. Wealth building is not about picking the one perfect stock. It is about following a system that works even when the world feels chaotic. The math does not lie, and neither do the monthly checks that show up in your account. Lamb fat is not going to wait for you, and the old way of investing in 4% bonds is no longer enough to protect your lifestyle. If you want to stay ahead of the curve and learn more about building a portfolio that actually takes care of you, make sure to subscribe to this channel. Hit the like button if this video helped you see your retirement options in a new light. Start with whichever fund feels the most comfortable for you, because taking action is the only way to secure your financial future. Thank you for watching, and I will see you in the next video.